All right, so today we are looking at FRM Part 1, Operational Risk. Okay, so I'm just going to call it as the Ops Risk. Now, before I get into the topic, let me give you a big picture. As you're aware, when we look at things from a banking perspective, right, we generally divide all the risk into three categories. First risk is the market risk. That means the bank will have certain value of assets. What if the value of the assets fall down, right? So general sensitivity to interest risk, foreign currency, all of that is under market risk. The second risk, which is a very prominent risk for bank, is a credit risk, which is what happens if the large number of borrowers start defaulting, or what if one large borrower who has borrowed a significant amount defaults, right? So that's your credit risk. And the third very important risk that we explore in this topic is the operational risk, right? The ops risk. Now, ops risk could be something as simple as, hey, there was a fraud by one of the employees, and therefore you ended up losing a large chunk of money. Or what if you had a rogue trader? Right? So all of us have heard story of Nick Leeson. If not, just Google it later on. But rogue trader, right? What if someone takes an exorbitant amount of risk and then ends up losing the money for you? So these are some of the examples of ops risk. So in this reading, we explore the entire ecosystem around ops trading. It's a very beautifully, nicely done reading. Does not get involved in too much of mathematics, but still gives you a good picture of the entire operational risk ecosystem. All right. So with this background, we're starting. Now, this reading is divided into 7 sections, and that's how I'm going to do the presentation. Now, I've created all these sections by myself just for a more structured learning perspective. First, we'll do introduction. We'll spend some time, mostly theory. Then we'll understand which are the 3 large operational risks. Then we will spend some time on Basel II, and after that, we will go to Basel III. Right? So how operational risk was looked at under Basel II, how operational risk was looked at under Basel III. Now, under Basel III, a lot of focus is on this concept called SMA. Okay, so we'll spend some time on SMA, and then section 5 is expanding on the concept of SMA a little further. So section 5 happens to be the biggest section in this reading. And then the theoretical section on section 6, which is how do I reduce operational risk? And then finally, can I buy insurance to protect myself? Okay, so that's the ecosystem. Now let us start with a basic introduction. So first, what is an operational risk? What do you define this, right? How do you define? So we'll look at, there are multiple definitions given in the GARP curriculum, but we focus on the Basel Committee definition. It is a risk of loss resulting from inadequate or failed internal processes, people, or system. So either it is internal, right? Something going wrong with process, people, or system, or it can also arise from an external event, right? So both of these elements are captured into the definition. What does it include? What are some of the examples? Number 1, your process failed. There was a particular way in which, let's say, a SWIFT bank account transfer or a SWIFT transfer was to be done. Something went wrong in that process. Or your system failed, human error, cyber attack, very important part of operational risk, terrorism, natural disaster, all of these are your ops risk. Even regulatory fines, litigation, rogue trading, or data breaches are part of the ops risk. Now, what does it not include? So I want you to explicitly remember this, that it does not include strategic risk, which is you making wrong decision, deciding to start a lending practice in personal loan segment, but you did not have expertise or the distribution to do it, right? So poor business decision, or something that affects your reputation, okay, for whatever reason. So please remember, reputational risk is not a part of ops risk as per the Basel guidelines. Correct? So then, as per Basel Committee, what are the 7 categories of operational risk? Number 1, internal fraud, employee theft, external fraud, robbery, cybercrime. Then employment practices, workplace safety, discrimination, all of those areas. Then anything around client, product, or business practices, for example, money laundering. So remember, money laundering is a part of ops risk. Damage to physical asset, natural disaster, vandalism, You live in India, especially in Mumbai, don't speak Marathi, you're in trouble. We've all seen the recent fiascos in India with the regional language. Business disruption, system failure, IT crashes, telecom, and finally your execution, delivery, and process management. Do you need to memorize this? No, not required, right? Just know that there are 7 categories within the operational risk under Basel Committee. Now, why is operational risk harder to quantify? Primarily for 2 reasons. Number one, that market risk and credit risk, we have access to a lot of data, right? And there are very well established models, for example, value at risk or credit rating. So the other 2 risks are easily quantifiable because of the access of data available, but operational risk lacks any type of robust data, because we know that these are low frequency but high magnitude events, right? Don't happen all the time, but when they happen, they are of sizable nature. So the data availability is a big concern in operation risk, and therefore a lot of estimation, a lot of modeling is required, which we will see in the subsequent section. Now, what is the data limitation? Number one, very little historical data available. Number two, losses often result from unexpected or relatively new scenarios, something that you might have not estimated, anticipated, or something that has not happened before. This makes modeling frequency, how frequently will I encounter losses, and we will see a lot of mathematical work around this. Just to give you a heads up, we will be using something called as a Poisson distribution for modeling frequency. Remember, Poisson distribution is used whenever you are modeling something that's of discrete nature. And severity of losses, that means, hey, if I have losses, then how big my losses are going to be. So this will come from the log normal distribution. Okay, and we'll see that, but modeling both of them becomes fairly difficult, right? So that's your data limitation. And that concludes our section number 1. Now, let me just give you, so let me kind of have this flow chart after every section, so we have a big picture of where we are. Okay, so introduction is out of our way. Now we start with the large risk. Now, what are large risk? So again, Basel Committee defines 3 risks which they feel out of the multiple risks that we have, these are relatively larger in size. Now, what are the 3 risks? Number 1, cyber risk. Number 2, something going wrong in compliance. Number 3, rogue trader risk. Okay. Now, what is a cyber risk? Includes cyber attack, fairly straightforward. They've given some examples in the GARP curriculum. Compliance risk, you paying fine or penalties for violating certain laws or policy. And rogue trader risk. What does rogue trader mean? In case if you're not aware of the Nick Leeson story, simply means that, hey, one of your trader on your trading desk takes really large size positions and results into significant amount of losses, right? And a lot of times these positions are taken without approval or because of lack of oversight. So that's referred to as a rogue trader risk. Okay. The case study here, a very interesting one, is a case study on Nick Leeson. Now, this particular gentleman was a trader for a bank of bearings, and he built some really large trade on Southeast Asian markets. And then there was an earthquake that resulted into massive amount of losses to the bank, to a level where bank was forced into bankruptcy, right? They had to shut down. It was a 200-year-old bank. So that's called as a rogue trader risk. There are many case studies, right? There has been issues with JP Morgan, Barclays, almost all the large investment banks have had their own rogue trader risk. So what should a bank do, right, to protect itself? Important from an exam perspective. Okay, let me give it a 3-star. To protect itself from rogue trader risk, it needs to have a really strong independence of the 2 main large offices, right? The front office, which is your trading office, and the back office. These guys should not be talking to each other. There should be independence so that back office can verify whether the trader is within the limits and all of those things. All right. So that concludes our section number 2. Now we'll go to, so introduction is done for us. Large risk is done for us. Now we'll go to section number 3, where we look at how the operation risk calculation was introduced for the first time under Basel II, and why calculation required, because remember, bank has to keep certain level of capital aside for market risk. It needs to have certain level of capital for credit risk. Basel II was the first one which introduced capital requirement for operational risk. right? So that's why Basel II kind of becomes important. Of course, we don't use Basel II anymore. All of us have moved to Basel III, but we need to have some idea of what happened in Basel II on operational risk. Okay, so let us start there. Here we go. Now, in Basel II, they're given three possible approaches. Okay, one, two, and the third one, which is advanced measurement approach. Now, the way you want to think of these approaches is that they progressively get more and more complicated. So if you're a smaller bank, you want to keep things easy, you follow a basic indicator approach. But if you can handle a little extra calculations, then you go to standardized approach. And if you can build a very, very complex mathematical model, mostly used for large banks, then you use AMA approach. This was very controversial. Okay, and in fact, this was controversial, and this was one of the reason why Basel III kind of discarded, the whole three approaches was because of AMA. There was a lot of controversy around it. So we'll see all of that. First, basic indicator, simple, straightforward model. It's an entry-level model. It will be used when systems aren't ready for advanced models, right? So when you cannot use standardized approach or the AMA approach, then you use basic indicator approach. Simple, straightforward. What they did is, they said, listen, you need to calculate your gross income. Okay. How would you calculate your gross income? For each of the business unit, they had defined multiple business unit. You calculate what is your interest earned, okay, minus the interest paid, plus if you have any non-interest income. Okay, so the net interest income plus non-interest income, you take a total of it, and then you take an average for 3 years, multiply that with 15%, that becomes your capital requirement. That was a simple, straightforward approach. Okay, so your very broadly your profitability of 3-year average profitability multiplied by 15%. Now, slightly more advanced. They said, listen, instead of just doing, and sorry, I made a mistake. I said business line wise. No, this was a total approach, right? Total at the bank level. And the standardized approach, which was more suitable for a mid-tier, type of method, which is between, not too advanced, but not too basic as well. Now, what you need to do is you still need to calculate basic indicator, but you need to calculate them segment by segment based on your multiple business lines. Okay. So how are you going to calculate the capital? So we're going to calculate gross income, okay, from that particular business line multiplied by applicable the percentage capital requirement. For example, under corporate finance, you had to save or allocate 18% capital to your gross income. All right. So do I need to memorize these items? No, I don't need to. But look at this. How many do we have? 1, 2, 3, 4, 5, 6, 7, and 8. Okay. So we have 8 categories here. And remember how we discussed there are 7 business lines, right? 7 main categories of operational risk in the introduction slide. So which means you would create 56 quadrants of sorts, right? So you decompose, for example, within corporate finance, you will find risk coming from each of the 7 segments, and then you try to model your risk. So it became relatively more complex than the basic indicator approach. Don't need to memorize it. Nothing is required, right? Just have an understanding of what is a standardized approach versus BI approach. Under BI, all that you're doing is calculating a total gross income for 3 years, taking an average multiplied by 15%, job done. Under standardized approach, you're calculating business line by business line profitability, okay, converting that to gross income, but every gross income is applied by a different percentage multiplier, not a flat 15%, and then summing it up, that becomes your capital. Now, under AMA approach, which was the most complex approach, what you had to do is you had to do something called as an annual loss distribution. Okay, which means you figure out some modeling technique, mostly Monte Carlo, and you figure out what could be an annual loss distribution. Now, this loss distribution, okay, where every amount is a loss, right, might look somewhat like this, okay, which is typically a right skewed distribution. That means most of the losses will be here in the center. There would be some extreme amount of losses. Then what you do is you calculate the mean of the distribution. So let's assume the mean of the distribution is here. Then you calculate the loss on 99.9th percentile, right? So you go really, really deep in the tail, you figure out loss. Let's assume mean happens to be 100. Okay, the mean loss is 100. And let's assume this loss happens to be 500. Okay, so then what is your capital requirement here? Your capital requirement would be 500 minus 100, which is equal to 400. Okay, so I hope this gives you some sort of a sense of where this is coming from. So which means under AMA approach, the most important thing for you becomes being able to model that loss distribution. And it was not easy because what is a loss distribution? It's just saying, hey, if this happens, loss amount would be 50. Okay, so that becomes one value in the distribution. Then some random combination again, loss value could be 70. In this fashion, you plot all your losses, then take a mean, take a 99.9 percentile value, and then take the difference of the two. So which means we need to be able to forecast loss frequency, we need to be able to forecast loss severity, and then once I have these two variables, loss frequency means how many times will I have events like this? Kitne baar loss hoga? How many times will I have the losses? Loss severity means, okay, this year I'm having losses 2 times, but how much? Will it be $50 million, $100 million? So this will come from log normal distribution, and then we'll run the popular Monte Carlo simulation, right? So loss frequency distribution could look like this. I'm just drawing something randomly. Loss severity distribution might look like this. Randomly you pick up 1 point here that, hey, this year I will have 3 losses. Then you randomly pick up 3 points here. First loss would be 100, then 150, and then I will have a large loss of 370. Now that becomes your modeling for one instance. In this fashion, you model 10,000 values, right? And then build a distribution out of it. So here's an example. Remember, distribution will always be right skewed. Okay. Now, generally, most of the FRM students know that typically on the left hand side of any distribution we have a loss, on the right hand side of any distribution we have a profit. But that is not true for a loss distribution. Why is that? Because under loss distribution, okay, which is similar looking distribution, maybe a little right skewed, you will have losses on the left hand side, but you will also have losses because the distribution is all about losses, doesn't include any profits. Now, on the left-hand side, you will have small losses. Obviously, on the right-hand side, you will have large losses. So therefore, what we are worried about primarily is the right tail here, right? So this is where you should be a little worried in terms of the extreme value losses that you might have. Again, how is capital set? It's set at 99th percentile unexpected loss minus the expected loss, which is your mean value. So excess. Why is that? Because expected loss is already provided for. It's already captured into your pricing, right? Whatever loan you give, you charge a little spread for your expected loss. It's the unexpected loss that you're worried about. So if my expected loss is, if my mean of distribution is 100, 99th percentile value is a loss of 500. 100 is already provided for. I don't worry about it. I am worried about this 500. But since 100 out of it is already provided, I need to provide for additional 400, right? Now, how is 100 provided for? So to a client, when I give a loan, I charge them an RFR of 10%. I need to earn at least the RFR. Plus, I charge a credit risk premium of maybe 3%. Plus, I will charge a small risk premium of maybe 1% based on my expected value of operating loss. So that 1% is supposed to cover the mean value, right? But it will not cover 500, so I need to provide for 400. That's the logic. Okay, and if you've understood this, then congratulations, job done. We've completed how many sections? 3 sections of the reading. Remember, total 7 sections. Biggest time will be consumed at section number 5. All right, so I hope you're with me. We looked at Basel II, we looked at basic indicator, gross income, 15% average gross income of 3 years, 15% job done. Standardized approach. What we did here is we had multiple business lines. I think 8 of them. We calculate gross income of each one of them, then have a different multiplier for each one of them, do a weighted average, add them up. AMA approach, we take difference between expected loss and the 99.9 percentile distribution loss, take the difference of the two. Okay, now we go to the Basel III. So let's start with Basel III. Now, first we'll discuss with what are the issues with AMA model. I'm expecting some theory questions here. Okay. First, high variability across the banks. Why is that? Because at the end of the day, you're using a Monte Carlo simulation. Simulation can result into very different looking models. Even if I have the same data, when I run a simulation model, I know that output can be anything, right? So same data that led to very different capital results for different banks. So imagine bank A and bank B. Hypothetically, they have the same distribution. Remember, we need two distribution. One for the frequency, hey, how many losses will I have? One for how big the losses will be, right? So loss severity. So imagine bank A and bank 2 has the same input data set, but they run Monte Carlo simulation. Now we know Monte Carlo simulation is a black box because it's randomly going to pick up numbers here, right? And therefore, the eventual loss distribution looked very, very different for bank A and very different for bank B. And therefore, no comparability of the results, and also opens up opportunity for manipulation, because if I were working with bank A or B, I will run my Monte Carlo simulation. If the output is not satisfactory, I'll say what, let's run it again. Let's see if we can get lucky. If not, let's run it again. It's computer at the end of the day, right? So therefore, same data, and I know I'm kind of repeating this point again, but it's important, testable. That's why I'm spending time. Same data, but led to very different capital results. Lack of consistency made cross-bank comparison difficult. Models were too complex, not transparent to the regulator, because all that you do is you say, hey, this was my loss distribution. How do you challenge it? It's picked up through random Monte Carlo process. It's picking up random data points from my distribution. So, we did what you asked us to do. So not transparent to regulator. Difficult to validate internal models due to subjectivity and regulatory push for simplification and standardization. So all these banks, Reserve Bank of India, the US Fed, the European Central Bank, they spoke to Basel Committee. They said, hey, we are not comfortable with this. Let's find a better way. And that's when finally in 2016, a new approach was introduced, the solution to all the problems that we have, which is called the SMA problem. Now, SMA approach honestly is also equally complicated. It also requires you to model, but at least still tries to bring some level of standardization. Okay. So remember, SMA approach replaces all previous method. What is the goal? Consistent, simple, and risk sensitive. So here's what you do now. Under SMA approach, now your capital is a function of two variables. Okay, you would still going to do business indicator approach that we saw earlier, where you have 8 different business segments, but you're going to bring in one more element, which is a historical loss segment. Now the logic is like this, and I want you to kind of get it nailed into your brains now. Under business indicator, this is a proxy for how large the bank is, because obviously larger the bank, higher would be the gross income, right? So larger bank will have larger business indicator. So it's a proxy for size. But think of a scenario where two banks have the same size. One of them does very risky lending, whereas other one does only mortgage lending, a safe lending, right? So you need to also capture the level of risk which is embedded into these banks, and that was captured with historical loss estimate. Okay, now what is a historical loss estimate? So it is nothing but, imagine the same size, but the one bank is lending it a riskier area, so they've had more losses in the past, right? So it captures your actual operational exposure. Now we are looking at loss purely from ops losses, not credit losses. So that means even though it's a loss proxy, it is also a proxy of your operational capabilities, correct? So that's what we're trying to capture here. So hopefully you got a good perspective of the BI proxy, which is a size proxy, and historical loss. Now your total capital will be And here's a good news for you. You don't have to do the calculations. You just need to know the logic. Okay, so your total capital will be capital that's coming from the BI risk and the capital that's coming from historical loss exposure. Okay, now let's focus on the BI part. BI part is similar to gross income, but, and a very important but, and a testable but. What it does is it captures both net and the gross component. Now, what do you mean by that? So remember earlier I showed you that BI calculation was your interest income minus interest expense plus other income, right? So interest income minus interest expense is nothing but your net interest income, and net interest income plus other income. Now imagine a situation where bank has experienced large value of operational losses. What bank will do is they will reduce the losses here in the interest income or other income. So think of a scenario where interest income is 100, okay, gross interest income, expense was 70, other income was 50. However, this other income 50 was actually calculated as other income of 70 minus losses of 20. So what these losses were doing is these losses were reducing the BI component. Basel III said, listen, that's not going to work. You cannot net reduce your losses and reduce BI, because that means more and more losses you have, smaller and smaller BI will be visible, right? Which kind of defeats the purpose. So here's what you need to do. Yes, you need to calculate net interest income. You need to calculate net fees and commission that you're earning. Okay. You have to capture trading income as well. But what we're going to do is we are not going to artificially reduce your BI, okay, because of losses or because of operating expenses. So if you're making losses, if you're making operating income, operating expenses, those will not be deductible under the BI approach. In fact, losses will be added separately under the loss section that we'll see very soon. So it aims to avoid BI underestimating operational footprint, and banks are grouped into different BI buckets. Okay, just a size proxy. Now, how would you calculate the loss component? Again, the calculation is not testable, but it's very interesting. So I want you to observe this carefully. We know that total capital of a bank is a function of BI component and loss component. Here's a formula for loss component. 7x plus 7y plus 5z. What does it now mean? So that x basically stands for average number of average annual losses over last 10 years. So you calculate actual operational losses over last 10 years, take an average, done. So obviously higher the value of losses you've had, higher will be the capital. But not only that, the bank is also going to punish you if you have losses of 10 million or more. So all the losses, imagine a bank which is having too many small losses, right? So then they have to worry only about the 7x component. They don't have to worry about 7y or 5z. But what if you had a few large losses? Let's say about 3 of them. One was 12, one was 18, and let's say another one was, I don't know, another 30, right? So I take a total of them 60 over a period of 3 years or over 3 instances. So average becomes 20. So then that 20 will also be added as a multiplier here, which means notice it's kind of double counting it. So it's counting these losses in the X section also, but large losses are double counted under Y section also. And not only that, if you've had losses more than 100 million, imagine you had one loss of 150, one loss of another, I'm just making up something randomly, let's say 250, so it gives me a total of 400, and one loss of 200. Then I will also take an average of the 3 losses. I'm guessing it's 200. Yeah, that's 200. And then that 200 will also be added in 5z. So what does it tell you? It tells you that, of course, more losses you make, higher will be the loss formula or loss capital. But if you tend to make larger losses, then you get double penalty under CY and under 5z. Okay, so that's your Basel formula. Hopefully that gives you a good perspective. I put in some multiplier logic for you. Losses are more painful as they grow. Higher losses signal riskier environment and therefore will require higher capital. Then banks with frequent large losses, also face proportionately higher capital requirement. That's a simple logic here. So imagine a situation where bank A has a few small losses, then they will have a low XYZ, they will have a lower capital. Bank B has the same business size but has headline losses, they will have a higher Z, automatically they'll result into a higher capital charge. And finally, okay, now I calculated BI, I calculated the loss capital. Now what do I need to do? So the combined BI component, which is size proxy, and loss component, which is risk proxy, using some Basel defined formula. Do you need to know what that formula is? No, not in the GARP curriculum. They have some formula. We don't care, but we know the formula includes some element of BI, some element of loss component. Now, for most of the bank, and this is again testable, for most of the bank, the capital requirement through BI component and loss component would be similar, because think about it, I'm already taking business income and to that I'm applying a multiplier, right? Now that multiplier is supposed to capture some of my losses. I'm also taking losses and applying that 7x formula. Now logically the two should result in same, but for a bank which is riskier, okay, the bank which is riskier, loss component would be higher than the BI component. So that's what you need to know from an exam perspective. Capital requirement will increase non-linearly with BI and actual loss experience. Okay, what are the goals and benefits here? Simpler than AMA, easier to implement, enforces discipline via historical loss tracking, less subjective, greater comparability, incentivizes banks to reduce actual large losses. Okay, and here's a good summary for you. AMA was replaced due to inconsistency, complexity. SMA balances bank size as well as the actual losses. Loss-based multiplier make the model more risk sensitive, and SMA is simple, consistent and transparent regulatory capital framework. Okay, with this we conclude section 4, and now in the next section, so our 4 sections are over, which was the Basel III, revision to Basel II, and we had issues with AMA, and then we discussed on SMA approach. Now we will go to the section 5, which is the largest section, and then we will do some work on determining the loss distribution. Alright, so we'll start looking at the section 5 now, where we have to figure out how to determine loss distribution. First, why do you need that loss distribution? Economic capital must be, okay, I think I missed a slide there. Good catch. All right, here we go. First, what is economic capital and what is regulatory capital, right? So very simple concept. Imagine a bank has total assets worth 100. Okay. Now these are assets. Based on the assets, certain risk-weighted assets will be calculated. Let's say 100 into, and let's assume risk-weighted assets happen to be, I don't know, I'm just making up 80. And let's assume capital requirement is 15%. So minimum capital that you need 15 into 15%, which should be 12, right? Now this is called regulatory capital, which is enforced by the Reserve Bank of India, or which is enforced by the Fed in the US. So legal requirement. What's an economic capital? That internally bank feels that okay, 12 is fine, but I think we should allocate a capital of 15 for doing this line of business. So that's my internal calculation for my own, return on capital type of calculations. Okay, so that's your economic capital. So we have two elements: regulatory capital, economic capital. Now let's understand the difference between the two. Regulatory capital is required by the regulators based on certain rules. Objective is to protect the depositors, ensure systemic stability. Economic capital is internal capital set aside by the bank to take care of the unexpected losses. This is based on internal assessment of risk, objective to cover actual risk exposure. Okay. Now, can economic capital be different? Yes, and it can be different because bank feels that, hey, according to regulator, my operation risk should have only 15% capital, but I have recently started a business that requires very heavy operations. Maybe I should have a higher capital. for internal calculation purposes, right? So my economic capital can be a little higher. It generally is already higher. Regulatory capital aims at industry-wide uniformity. Economic capital is very bank specific, right? Regulatory capital will have the same set of rules for all the bank, but economic capital, I can do it for my own purposes. For most of the banks, which are sophisticated, they will have economic capital greater than regulatory capital. Okay, by the way, this section is not testable. I'm doing this so that you build a better perspective. But for smaller banks or banks which have a less risky portfolio, rarely regulatory capital will be higher. Okay, for most of the banks, economic capital higher, regulatory capital lower. And economic capital is useful for internal pricing, risk adjusted return analysis, and it is useful for capital efficiency. For example, for a particular business line, my internal capital allocation is 100. This year they generated profit of 18, so my return on capital employed is 18% or something like that. Okay, so hopefully that gives you a decent enough perspective. Okay, that allows me to go to section number 2 on this. That now under section 5 of the curriculum, the GARP curriculum, we have to figure out to model something called as a loss distribution. Okay. Now, the first question is, why do we need that loss distribution in the first place? So let's see. Economic capital must be based on actual loss behavior, not some arbitrary percentage. Risk manager need a full loss distribution to calculate A, the mean expected loss, and then calculate 99.9th percentile unexpected loss. Operational risk is generally rare but high severity losses, fraud by an employee, cyber risk and all of that. And it's long right tail in the distribution, correct? We are going deep in the tail when we have those extreme value losses. Now, loss distribution will help us figure out how often the losses will occur, which means the frequency. Remember, I told you earlier, frequency will be captured by Poisson. How big the losses will be, which will be captured by the log normal distribution. And then worst case loss distribution will typically run Monte Carlo. Without this distribution, capital might be either too low or too expensive. Then the third subsection, remember we have to do total 10 subsections under this. Now we go to Poisson distribution. I want to slow down a little bit here. Next two sections require some calculations. I've put in a lot of practice examples for you. Okay, now Poisson distribution was repeated in the cont section, but I'm going to do the whole thing again slowly, step by step, so you understand this piece. What is the purpose? To figure out how many losses will I have this year. That's it. We want to figure out frequency. Frequency means kitne baar hoga. How many times will it happen? Once a year, twice a year, 10 times a year. Assumption. One event doesn't have anything to do with the next event. The events are independent. That's a basic assumption of Poisson distribution. Then the average rate, lambda, and this lambda will come very often, okay, and we'll talk about this a little bit more. But average rate, which is a constant over time. Probability of something happening is, let's say once in 10 years gives you a 10% lambda. That means you're expecting 10% probability at point of time, right? So that's your lambda. And multiple events can't happen at the exact same moment. Okay, so these are your three assumptions. Don't need to memorize them, but general perspective. Now, here's your probability of having n losses in a year. N means how many losses. Okay, the formula is E raised to lambda negative multiplied with lambda raised to the number of losses you're looking at divided by n factorial. Okay, so if lambda is given to you as 2, given to you, right, as a part of the exercise, then what is the probability of having 0 losses? So then this would be E raised to minus 2 multiplied with 2 raised to 0 divided by 0 factorial. Okay, so let's do the math. Let's do it together. I'm firing up your Texas calculator. I'm pressing 2 on the screen, making it negative. second e raised to x, STO1, then 2 raised to x 0, anything raised to 0 we know is 1, so STO2, and then 0 second x factorial, we know that that's also 1, STO3. So RCL1 into RCL2 divided by RCL3 gives me 13.53% probability. Okay, what is the probability of having exactly one loss? So then this will become e raised to minus 2. Remember, my lambda is still minus 2 into 2 raised to 1 divided by 1 factorial. So let's do it. 2 negative. In fact, this part will remain same, so I don't need to do it. The second part will change. So 2 is STO2, and the third part is also same. So RCL1 into RCL2. Did I make a mistake there? RCL1 into RCL2 divided by RCL3, I'm getting 27%. What is the probability of having 4 losses? Okay, so e raised to minus 2 into 2 raised to 4 divided by 4 factorial. RCL1 is same, 2 raised to 4 STO2, 4 second factorial STO3, RCL1 into RCL2 divided by RCL3 gives me about 9% probability. Okay, so hopefully you're getting a perspective of how that Poisson distribution is working. E raised to lambda negative multiplied with lambda raised to n divided by n factorial. That's your framework. Now, I would recommend that you practice all of these number of losses with different lambdas just so that you build your muscle memory around the calculation. Now, what is this doing you? It is giving you probability of having one loss, probability of having 2 losses, probability of having 3 losses, and so on. Looks like there is a mistake here, or I'm not sure. You can look that up yourself. Okay. I've also put in 4 or 5 practice questions for you to play around with solutions for each one of them. Then we go to loss severity. Okay, fine. Now I understood that there's a 27% chance that I will have 2 losses this year, but how big are those losses going to be, right? So for this, we use a log normal distribution. Remember, a log normal distribution is a right skewed distribution. All the values are positive, you're constrained to 0. That means you will only have losses, not have profits, because we are modeling only losses here. And my large losses will be here in right tail, right? So this is the area of large losses in the right tail. Okay, so once we've estimated how often losses occur, we must assess how severe each of those losses could be. Log normal distribution is used to model those losses because A or 1, loss values are always positive. Second, most of the losses are small, so I have a high density here or small losses, but few can be extremely large, right skewed behavior. Third, actual loss data is highly skewed with a fat right tail behavior or right skew behavior. Now, if X is the loss amount, okay, which you're estimating that, hey, I think I will have a loss of $10 million, then log normal of X, okay, because remember X is log normally distributed. So when I take a natural log of it, then it becomes normally distributed. Okay, X log normal distributed, therefore natural log of X is normally distributed. Okay, in the same way, once we know that this is my mean and variance of the actual loss amount, then we can figure out what would be the mean and variance of the natural log X. Okay, so let's see how will that work. First, if I want to calculate the mean and variance of my ln x, right? If I want to calculate mean and variable of the natural log values of x, this is the formula I will use. Step number 1, I will calculate a concept called CV square, coefficient of variation. Now this formula you might have come across in basic quant classes, but if you haven't, it's very simple. It is nothing but mean divided by, and my apologies, I did the other way around. Okay, this is a mistake. Okay, it should be mean divided by, let me think about it. No, this is correct, my mistake, my apologies. In fact, this is in fact how I remembered it, that it's kind of opposite of Sharpe ratio in terms of numerator denominator. So here the numerator is actually standard deviation and the denominator is mean. Okay, this is referred to as coefficient of variation, CV. Okay, so what you need to do is you're given mean of losses, you're given standard deviation of losses, you want to convert that to log normal amount. Step number one, you need to calculate coefficient of variation. Then step number two, you square it. Okay, now curriculum calls coefficient of variation as W and then it shows W square. We're not going to do that. We're simply going to call this number as CV squared. Okay, or CV square, which is standard deviation divided by mean, opposite of Sharpe ratio. Sharpe ratio standard deviation is in the denominator, in CV standard deviation is in the numerator. So we'll make it easy for you to remember. Now, once that is done, CV squared, then how would you calculate mean of the log normal loss? So mean of the log normal loss would be natural log value of mean divided by 1 plus CV squared under root. Okay, so what do I need to do? I need to take the mean of the normal value, normal losses, then 1 plus CV squared under root. I need to calculate mean divided by 1 plus CV squared, and for this I need to take a natural log. What would this be? This would be mean of the ln x. In the same way, what would be the variance of the distribution? So variance of the distribution will become natural log of 1 plus CV square. Okay, so two formulas, you need to memorize them. This is testable, okay, but we'll practice a lot of questions so that you build muscle memory around it. Now, once you have mean ln and variance ln, then you build a distribution from it, right? Because at the end of the day, you know that mean ln and variance ln is normally distributed. So you can pick up one random value from normal distribution and then you can simulate your losses. Okay, let me show you how. Let's assume you're being told that, hey, listen, mean of losses is 80, standard deviation is 40. Okay, so step number one, let's calculate CV. 40 divided by 80, which is equal to 0.5. CV square 0.5 square should be equal to 0.25. Now, once I have CV squared, I can calculate mean of ln, natural log of that mean distribution. What would this be? This would be natural log of, we use this particular formula, okay, which is mean. Mean given is 80 divided by 1 plus CV squared is 0.25. So it's 1.25 under root. Let's do the math. So 80 divided by 1.25 under root button equal to natural log, I'm getting 4.27. This is the mean of ln value. Remember, this tends to be normally distributed. This mean in 80, this is of log normal distribution. So we're converting it to a normally distributed metric. In the same way, how would I do the variance? So 1 plus 0.25 and then just the log normal, so giving me 0.223. Okay, let's do one more example. Now here we have a mean of 150, standard deviation of 60. So let's do 60 divided by 150 square. 60 divided by 150 square, we're getting 0.16. Let's calculate the mean. So mean will become 150 divided by 1.16 under root. So 150 divided by 1.16 under root equal to ln. Forgot the ln operator here. So that should be equal to 4.93 or 4.94. Variance will be 1.16 ln. So 1.16 ln is equal to 0.14. One more example. Let's do this one. Mean of 100. Again, I made the same mistake. Standard deviation of 40 divided by mean of 100 squared. 40 divided by 100 squared is 0.16. Okay, then 100 divided by under root 1.16 ln. So 100 divided by 1.16. No, made a mistake. 100 divided by 1.16 under root ln is giving me 4.53. In the same way, 1.16 ln is giving me 0.148. Okay, there you go. Hopefully that gives you a good perspective of how to work with this translation procedure. Then the fifth subsection, which is on Monte Carlo. So Monte Carlo is used to estimate the total operational risk loss. Okay, and what are we going to combine? We'll need first distribution, which is my Poisson distribution. Remember, a discrete distribution, right? That will tell me how many losses in a year. Loss severity, which is a log normal distribution, will tell me how big the loss. Now, what Monte Carlo will do is randomly pick up one value here and the corresponding values here, give you the loss. Okay, so here's a process. Step number one, estimate loss frequency using Poisson distribution. Step number two, estimate loss severity using log normal distribution. Of course, you need parameter mean ln and variance ln, which is a log transform amount. Then step number three, simulate 1 year return, random draw from Poisson, random draw from loss distribution, sum of the losses. Then repeat the process 10,000 years. That means 10,000 times. Then once you've repeated the process 10,000 times, you get a distribution like this. Take 99.9th percentile, take the expected loss, take the difference, job done. Okay, so here you go. Example one. Randomly you picked up two Poisson draws. Then you went to log normal distribution to pick up losses. The first loss was 120, second loss was 85, total losses 205. Next time you randomly picked up, your random number came out to be 3 losses. The random losses amount came out to be this much, and year 4, year 5, now you need to repeat this 10,000 times, right? And keep on repeating the process. So here's one more example just to give you what calculations are going in here. Okay, let's assume lambda happens to be 2, mean loss happens to be 100,000, standard deviation happens to be 50,000. Okay, now what will we do? So we'll estimate mean ln using the formula we've seen. Because we have mean, we have standard deviation, we can compute CV, so we do the whole drill, then we run a 10-year simulation. Here's an example, one more example. Let's assume lambda 1, mean loss 200k, standard deviation 80k. You repeat the same drill. Okay, and you keep on repeating like this. These are some of the practice examples, but again, you don't need to do this because that random value picked up is in Monte Carlo simulation. You can't run Monte Carlo simulation on the exam, so all that you need to know is the background logic. That's it. Then finally, step 6, determine the estimation process. Actual data. Now you have estimated loss frequency and severity, but you require actual data to build that distribution from internal or external sources, but you also need expert judgment. That means, hey, how will I get my Poisson distribution? Where will that come from? How will I get my loss severity distribution? I need some data to work with, right? So either internal data or external data, or even judgment for that matter. Now, loss frequency can be based on internal data, external data, can be adjusted based on quality of internal controls. For example, if bank experienced 30 losses over 6 years, then what is their annual run rate? Annual lambda becomes 5 events a year. Getting hang of it? If bank had 70 losses over 10 years, lambda becomes 7 losses a year. That becomes a mean of your Poisson distribution. How would you figure out loss severity? Look at this. It says it is more challenging, especially for rare high severity losses. How do you estimate losses from a cyber attack, right? Very tough. Use internal data if available. Use external data from vendors. Use log normal distribution. If internal data is insufficient, use expert judgment or do scenario analysis. Then combine the both. Some additional tips. Data should be clean to exclude near miss events, data entry errors, unrepresentative outliers. Happened one time, but not expected to happen going forward. Remove those outliers. Use long historical period, 7 to 10 years. Ensure consistency in how you're doing your maths. Key takeaways. Estimating input is where subjectivity enters the process. Proper estimation is required. Remember, garbage in, garbage out. So if your model input is useless, then the model is out, kind of useless. Independent validation and periodic back testing are important. Then what biases can occur, okay, in the process? Number one, loss data has inbuilt biases. What are the type of biases we're looking at? Number one, reporting bias. Number two, scaling bias. Okay, we have to do some calculation here, testable. Then we have to do some inflation adjustments, and then we have to do some control improvements over a period of time. Let's look at an example. First, reporting bias. Public data set often include only large losses. Imagine a bank had a small cyber attack on one small part of the business. They paid some money, ransomware, but they decided not to report. I don't know if banks can do that, but if I were a bank, I would try to protect reputational risk. So if there is a regulatory requirement, I'll report. If it's a smaller thing, I'll probably not report, right? So remember, all the public data does not capture smaller losses, only large losses. Second, small, moderate losses unreported. This causes severity estimates to be too high. Expect a theory question. If I were writing a question for you, I will say, hey, I'm using external data. On an average, my bias is upwards or downwards. My bias is always upwards. Then because of that, your capital requirement might be overstated. Scaling bias. When using losses from other banks, how do you estimate loss that you had yourself, right? You need to do scaling, and your scaling can be too aggressive or too conservative. For example, look at this. Imagine Bank A historically is a $500 million small bank, and they reported a loss of $10 million. Okay, but Bank B happens to be a $1,000 million bank, double the size of Bank A. Now, what would be a good amount of loss for this bank? Now, one way to do it is you can do proportionate calculation. You can say 500 had 10 million. So maybe 1,000 million should have how much? 20, right? Cross multiplication. But this method doesn't work. The Basel actually reports a slightly different method. Okay, so what would be that different method? So look at this carefully. I will use consistent operator here. Okay, so imagine Bank B was that smaller bank. Okay, it had a capital of 500 million, and let's assume it had a loss of 10 million. Bank A is a larger bank. It has a capital of 1,000 million, 1 billion. What should be the amount of loss? Okay, so let's look at this. Estimated losses for Bank A is equal to observed loss of Bank B. Okay, what was the loss? 10 million multiplied with Bank A revenue. So let me just convert that to revenue metric, easier to compare. So Bank A revenue 1,000 divided by Bank B revenue 500. Look at this proportionate scaling, but this scalar will not be remaining 2. Rather, we will be charging it an exponent of this 0.23. Okay, this is the beta in the formula. This is what Basel recommends. It says don't do linear calculation, rather charge this multiplier beta of 0.23. I think you would be better off memorizing this 0.23 number. Okay, this will help on the exam. So if I were to do the calculation, 2 raised to 0.23 actually gives me, let me try again, 2 raised to 0.23 gives me a 1.17 multiplier as against a 2 multiplier multiplied with 10. So here my losses are becoming 11.72. Okay, now that's a Basel recommended method, so we kind of want to learn this. Second, if it's an older loss data, then you need to do inflation adjustment. Now, I can combine the two items and create a beautiful question like this. Okay, look at this. Imagine Bank B, okay, 5 years ago, which has currently revenue of 500 million, 5 years ago had a loss of 10 million. Okay, whereas Bank A has a revenue of 1,000 million. Now, this is a 5-year-old loss. Obviously, on inflation terms, is going to be higher. So what's the inflation? Inflation, let's say, is 10% per annum. So then what would be an inflation adjusted loss? It will be 10 million loss multiplied with 1 plus inflation rate over a period of 5 years. Let me do it on the TVM row or just the formula. 1.1 raised to 5 into 10 is giving me a loss of 16 million. Then I will take this 16 and then I will do the proportionate calculation, which is 1000 divided by 500, but to an exponent of beta of 0.3. So let me store that 16.10, 2 raised to 0.323 multiplied with that should give me a loss of 18.888. Okay, so hopefully that gives you a little perspective on how to deal with this. I've put in plenty of practice questions for you here. Please have a look at them, make sure you understand. Hopefully, these practice questions will give you a decent idea of the kind of questions that can be tested. All right. That allows me to move to subsection 8 on building scenario analysis. Scenario analysis is used when data is scarce, especially if you're looking at low frequency or high severity data set. Focus is on what could happen, not necessarily what has happened. Risk manager will try to identify rare but plausible events and then severity of each of the event. Where will the scenarios come from? Historical events, known losses at peer banks, hypothetical events generated via workshops, brainstorming sessions, and then consultant expertise. How is it done? Define the scenario. Let's say cyber attack shuts down trading desk for 3 days. Estimate how frequently will this happen. If it's expected to happen once every 5 years, then you assign a lambda value of 0.2. If it's expected to happen once over 100 years, you assign a lambda value of 0.01. Okay, which is simply 1 divided by 5 or 1 divided by 100. Then estimate the severity of each, 1%, 99%, remember log normal distribution, and then finally you want to run Monte Carlo. Okay, so here's an example. Imagine you estimated frequency to be 0.01. First percentile loss is 20 million, 99th percentile is 200 million. So what will you do? First, you'll convert these losses to the log normal values. Then once you have log normal values, you take the mean of each one of them. So you'll have a mean of the log normal values, which is mean of these two parameters. And then you will have a variance, which is scaled by the normal distribution. Same scenario. Okay, this is a little more comprehensive. Look at this. Major data breach. Lambda value, first percentile, second percentile given. What is the mean? Take mean here, divide by 2, 4.206. What is the variance? So take the difference of the 99th percentile and 1 percentile, divide that with the appropriate Z value. Remember, for 99%, the one tail Z value is 2.33, right? Again, you're not responsible for this calculation, but get a sense of what's happening here. Okay, I've put in few more examples. You can have a look at them later on. What are the benefit? Better awareness of tail risk, fills in the gap when historical data is not available, useful for modeling never happened but could happen events. Okay, that allows us to go to section 8, which is fine. Now I've done all of this exercise so that I can allocate economic capital to different levels. Now what's the benefit? So let's look at this. Economic capital is calculated firm level but often allocated to individual business units. Why? Because I want to measure performance metrics like return on capital, accountability, and better risk management at the firm. How is it done? Estimate each unit's contribution based on frequency, based on scenario. Second, allocate capital proportionately. Higher risk automatically will receive higher capital charge. And then use this capital to business decision like pricing, setting limits, or bonus pools. From a manager perspective, units which have a lower operational risk automatically will have better ROC, because remember, what is your return on capital formula, right? It's your profit divided by capital. Now, if you are less risky, then automatically capital will be lower. That means your overall return on capital will be higher. Then free up resources for growth. If you're running a business unit in a bank which tends to have very frequent losses or very large losses, you will have higher capital. You'll be forced to improve controls. Okay, so here's an example. Imagine there are two business units. Unit A has a high transaction volume but very few errors. Unit B has high complex processes, tends to have regular operating losses. Unit B will automatically have more economic capital, and that means the return metric will come down, so unit B will be incentivized to reduce the process risk. Okay, that's it. And finally, it brings us to this beautiful concept called power law. Again, if I were writing tests for you, I'll be very tempted to put up a question here. I've put in plenty of practice examples. You'll see how they flow. Okay, so here we go. What is the use of power law? Power law is basically used to estimate extreme value events. Okay, now in the tail, but in order for power law to work, okay, imagine this is a very large loss. Okay, and let's assume this is a very large loss. Now, for me to be able to estimate what would be the value of a very large loss, I need to have some sense of the value of large loss. Then I can say, hey, at 5% my loss is this much. How much would be my loss at 1%, right? I can do some sort of a scaling using power law. So it helps you get a sense of what is going to happen in an extreme right tail. That means we're looking at rare but huge events. Okay. Now, there are two formulas here. This is the first one. This is a general expression of how power law works. But this is the formula that is going to be very helpful for us. Which one? This one. Now, what is the job of formula like this? So let me show you. Imagine at fifth percentile, okay, at fifth percentile, I'm looking at a loss of 20 million. Okay. How much loss will I have if I enter into the first percentile? That's what we're trying to figure out with power law, for which you need an operator called the alpha operator. Okay. Now what this alpha operator will be given to you on the test. So how would you make use of this alpha operator? You will say 20 million, okay, multiplied with 5% divided by 1%. Okay. Now remember, it's a little counterintuitive because if I were to do proportionate calculation, my calculation would have been 1% into 20. But in power law, the higher value, higher percentage in this proportion will be in the numerator. Kind of have a sense of that always. Okay, it will always be true in power law that the higher percentage value is in the numerator. Now again, like how we saw with previous beta scaling, this also needs to be scaled by 1 by alpha. So that should make life easier. And when I do this math, let's see how much is that. So this will be 5 raised to 1 by 5 bracket close multiplied with 20 gives me 27.59 million. One more example. Let's assume fifth percentile is 50. How much would be the first percentile? Alpha value being 4. So I'll say, okay, 50 multiplied with 5% by 1% raised to 1 by 4, right? 133. One more. 10 percentile is 100. How much would be the first percentile? Alpha being 3. So sure, no problem. 100 into 10% divided by 1% raised to 1 by 3. Coming out to be 215 million and so on, right? So practice a few questions. I think you should be okay with it. Summary, power law is simple way to estimate rare catastrophic losses. Useful when internal data doesn't contain all the tail events. Lower the alpha, higher the tail risk, because remember your exponent is 1 by alpha. So lower the alpha, higher the exponent, higher will be the risk. So this is important again for a theory question. Lower alpha will result in more tail risk or higher tail risk. And that concludes section number 5 for us. I told you earlier, fairly large section, but we're done with it. Okay. So here's what we did in section 5. We started with first, what is economic capital, regulatory capital, then why loss distribution is required, then Poisson distribution. I hope you remember the formula, log normal distribution. Hope you remember mean and variance formula, how to run Monte Carlo estimation process. Then we looked at some biases, we looked at scenario analysis, allocation of economic capital, and finally we looked at power law formulas. Okay, now we have to do 2 final pieces. Theory, easy. We have to look at how do I reduce operational risk, and hey, can I buy insurance against operational risk, and if yes, how? Okay, so just 2 sections and we're done. Let's go to section number 6. Okay, first, why is it important to have proactive risk reduction? Because you want to reduce the probability and severity of large losses. Risk team should not only focus on capital models but also on prevention. When large losses occur at a firm, other firms tend to study and learn. If something happens at JP Morgan, Barclays will try to understand what happened. Identify why it happened. Most of the operational losses are preventable if you do better training of your employees. If you have better IT system, you can avoid those losses. But does it mean you should immediately do it? No, you should always do a cost benefit analysis. For example, if you change your IT systems, cost would be $500 million, but otherwise you are having losses of only $1 million. So cost benefit doesn't work. It's okay to then take those losses as long as losses will not be too large. Are you getting it? So always a cost benefit analysis. Now, Basel recommends a very interesting component here. It says, can you figure out a slightly different way of doing risk control and assessment? And it's nothing but a large brainstorming session with your line managers. Okay, typically risk management is a separate team. These folks sitting in their head office doing all their maths. But a lot of risk originates where, at the place where line managers are sitting, right? So imagine your bank teller. Why don't you go and talk to these guys and ask them, what do you think can go wrong? Correct? So do some brainstorming exercise and based on that, try to figure out what could be the risk. That is referred to as RCSA. Okay. Now it's a bottom-up self-driven assessment for staff and managers. They are supposed to identify, see, this is not for risk professional. This is for line managers, people who are doing actual business, right? Figure out what has been the last losses, future risk. How would you do it? You interview with them, questionnaire, incident reviews, and so on. Okay. Goal, reduce frequency, severity, or both. Then subsection 5, hey, can I make a list of these early warning indicators or key risk indicators? Sure. These are some of the metrics: high staff turnover, unfilled position, and so on. How to use, track these KRIs over time, investigate abnormal trends, use automated tools to detect suspicious patterns. All right. Do you need to educate your employee? Of course, yes. Ethics training, compliance training, and all of it. Build a risk-aware culture where misconduct is socially unacceptable. There are some examples given in the curriculum. We can skip through them. And then communication discipline. This is where bank employees are communicating with, maybe their colleagues. Okay. Another bank employee, or this is where bank employee writing an email to a client outside. Both the communication needs to be super carefully monitored. Large legal risk can arise because of careless email or phone records. They've given incident of how one analyst was, one trader wrote an email to his colleague or his friend saying how he was fooling client by selling them, some products or something like that, right? So you want to be careful about all of these emails, just aware that any email that you're writing from your business account can be made public someday. So want to be aware of that, some theory around it. Know that all your lines are always recorded, your audit trails are, your emails are audited. That's it. And finally, that brings us to the final section 7, which is insurance against the ops risk. Can I buy insurance? Sure. Most of the ops risk can be insured against. Insurance will help you reduce severity of losses. They will also help you on the capital front under SMA method. So remember, if you buy insurance, to some extent your capital requirement goes down. But does it mean I should buy all the insurance that's available? Not necessarily, no. Not necessarily, yes. Cost benefit analysis needs to be done. Now, what is the risk to the insurance company? First risk, moral hazard. You might have seen this risk somewhere else. Second risk is adverse selection. Okay, let's look at moral hazard. Moral hazard means insurance may encounter reckless behavior. It's like, hey, I've bought the insurance, I don't care. Let me just take risk. I don't even need to audit what's happening. That's a classic moral hazard risk. It's like when you buy car insurance on your car and you start driving recklessly day onwards because you have insurance, right? That's your moral hazard risk. So example would be bank traders start taking unauthorized risk. If you have a rogue, trader kind of insurance, and think from a bank trader perspective, gain occurs, fantastic, loss occurs, and claim insurance, right? What are the controls to mitigate? Strict trading limit, insurance not disclosed to the traders, very important. Beautiful theory question can be structured. The trader should not know that there is an insurance, because if they know, then obviously it will influence their behavior. Then investigation post loss, policy void. If risk controls are breached, that means within the policy certain rules are set. If the rules are violated, you don't get payout. Then deductibles. Deductibles means if your loss is 500 million, first $100 million losses will always be borne by the bank. Anything after that would be borne by the insurance company. Or co-insurance. Co-insurance basically says if there's a loss of 500, you absorb 250, I will absorb 250. You as in 250 will be bank, 250 will be by insurance company. All of these are solutions to the moral hazard risk. Payout limit. Hey, we are going to cap your losses to 300 million. So if you had a loss of 500, no problem. Bank will absorb 200. Insurance company will pay only the capped amount of 300. And once you made losses, then next year will charge you a higher premium. Okay, so that's your moral hazard risk. What would be adverse selection? Adverse selection means I end up getting all the wrong type of clients. So if I were selling car insurance and let's say I set my premium to be very high but give very good coverage, all the reckless driver will come to me to buy insurance, right? That's the adverse selection. So high risk institutions are more likely to seek insurance. For example, banks which already have poor cyber security, or they will be happy to buy cyber insurance, right? If I'm a safe institution, why would I buy? Then I will find your premiums to be too high. Controls to mitigate. Detailed due diligence before offering cover, requirement to prove strong internal controls, premium based on risk profile. Higher the risk profile of the bank, automatically higher will be the premium charged. What are the common risks? These are some of the risks which are generally bought through insurance or protected through insurance. Risk manager should understand insurance limits, internal controls with the insurance terms, view insurance as a line of last defense, not a substitute for control. And with this, congratulations to you. This large chapter is covered. I have ensured that everything that can possibly be tested from this reading is covered in my sessions and my presentation. The way to revise this is the presentation is available on the FinTree system. Download this, read this a few times, practice through those examples I have put in, and you're good to go. All right, so good luck. I hope you enjoyed the session. I will see you in next class.